Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Welcome to Sparta Market Outlook podcast, where we'll break down the latest trends and key developments shaping the global oil and energy markets. I'm Rachel Williams, and today we're diving into some major themes moving the market right now. Tariff uncertainty, the so-called Trump slump, positioning shifts in crude, is the market oversold, and are diesel and jet cracks poised for a rebound? And what does all of this mean for all of you listening in? So to help unpack all of this, I'm joined by our lovely team once again. Neil, James, Jorge and Phil. Hi guys.
Hi. Hello. Hello.
And together we're going to cut through the noise and highlight what really matters. So look, let's get started. We've got quite a bit to cover today. Why don't we start with tariffs? So we had a very lengthy session on this last week, and no doubt for the next weeks and the months to come, it will be quite similar. So how bad is the market reaction right now? And do we see this as an overreaction or a sign of deeper macro concerns? So Neil, do you want to kick us off on this one?
What a question to start off with.
Sorry.
Okay. Well, last week we talked for an hour on what these tariffs would do, and then, as we said at the end, this will probably all change by the time we publish, and in the end, it did. So it's tariffs on and off.
Very true.
Which is very annoying, but there we go. Yeah, I just wanted to point out. I mean, the purpose of this first half of the podcast was flat prices down 9%. Over the last month. Obviously, if you look at wider markets, particularly US markets, it's not a very good story, right? The so-called Trump slump, as you just said, and Trump changing his tone, even the things he says on US growth, let's say, outlook for this year. He was talking about mega wealth and mega growth, and now he's talking about pain, which markets are not responding well to. And the purpose of this is just to maybe do a roundtable to say, okay, flat prices down, obviously, with wider markets. But if we look at the things that we can observe beyond that, let's say what's happening in the physical market, including things like time spreads, it's not an emergency, is it? Crude time spreads have held up really well over the last week. In fact, they've strengthened. Yeah, I think we just want to do a quick roundtable on that, right?
Yeah. Phil?
We'll talk about each of the products in turn, but certainly as a kind of highlight or a high level statement at the beginning, you're right. From what we can see in the physical market, nothing too alarmist right now, right?
Yeah, we can do lots of things. We could go straight to what we think will happen with Trump, but is there any point? I mean, I had this written down. What do we think will happen with Trump? What's the point in talking about it? I mean, I have one thought which I want to reiterate from, I think, a few weeks ago already. The thinking I have is, particularly on the impact on markets.
Okay.
Trump can be, or the Trump administration can be market sensitive and rein in the worst of its ideas and I talk about the worst of its ideas not in a political sense, but in the sense of their potential impact on growth and equities, basically. Or he can be the kind of full version of what you think he might want to be, but he can't be both these things, at least not 100%, right? Because in the end, the market talks and money talks. And I don't know where you land in those two things, but it does seem like the tariffs, he rose back on them when the market reaction is bad. Is that a fair thing to say?
I think you're right. Look, I think the whole Trump conversation is going to continue, right, over the next couple of weeks. We've noticed that, every 24 hours there's something new kind of coming up in the news. So in terms of how locked in are we to such an aggressive kind of trade environment, shall we say, is probably one to watch. And we can talk a little bit about that kind of in terms of the impacts to each of the products, that's for sure. But look, if we think about kind of the conversations that are happening now in the market in terms of, a recession or can we just touch upon that? So what signs are we physically seeing in the market then in that case? So putting aside kind of some of the rhetoric around kind of trade wars, but what are we physically seeing in terms of, inventory as an example?
Yeah. So just one last point in that then. The reason I mentioned like which ways it's going to go, there's definitely a scenario where the trade war heats up and crude flat price tends to fall with markets. And that's maybe one of the key points of today. Do we think that the crude will end up oversold in the short term? Like obviously the macro outlook could change over the next 6 months, but that's a longer term thing. And, if this trade war heats up and flat price tends to sink again, and if you look at managed money positioning, I mean, it is fairly bearish just now, but there's room to the downside, even relative to the levels we've seen last year. So there's a scenario where flat price heads down to, $60, I guess. And then we have to reiterate, do we see that in the physical market? So then to ask, to get to your question, what do we see in things like stocks data? So US crude commercial stocks, they've been building, yes, but it's completely par for the course from a seasonal perspective. In fact, in the last couple of weeks, it's kind of been underperforming the seasonal average in terms of builds. US products, I mean, you guys can talk about that later. They looked a bit kind of buildy, let's say. They're kind of building a bit the last 2 weeks, but the last report we got yesterday was fairly bullish, right? And then we look at things like Japanese high frequency product stocks. They look tight. The last Jody data we had in December, that was quite bullish. And then I was looking at just an anecdote here, right? So it's like anyone who's on X or Twitter knows the guy Staunovo who posts all kinds of stuff related to oil data. And there was a funny one where the IEA just brought out its report today and is still posting like a really long Q1 balance that is.
Okay.
But then observed inventories over January and February are drawing really nicely versus December. So there's a big, I mean, we're not following all this stuff, right? But there's a big discrepancy still where even in that kind of, and I just had to laugh at it because it's like, okay, so the observed stocks are not looking particularly loose and we've still got the IEA bearish, what do we call it, narrative. So it's not working out yet.
Yeah, I mean, we touched upon that a couple of weeks ago with Julian Mathonia in terms of the discrepancies between kind of some of the reported numbers, shall we say, and kind of maybe what's actually kind of physically happening in the market. Okay, so I guess my take from that then is potentially kind of flat prices are incredibly reactive at the minute to sentiment around trade war and sensitive to that. But the physical markets themselves, particularly in crude, kind of maybe showing kind of something a little bit different. So, I mean, we can get onto the products in a little bit. But look, Neil, just staying on crude for a minute, I'm going to ask you two questions in one because I'm full of colds, to be honest, and I don't want to cough over you. So that would be one. But look, two questions. So you mentioned earlier that Brent dropped 9% since mid-Feb. Managed money positioning is fairly bearish. So, and you spoke a little bit around kind of downside risk, but how much more do you think we got? If you want to build that out, I know I'm asking you once again kind of to talk about that. And despite the price reaction, look, we've seen time spreads relatively healthy. So what's supporting the structure and how does that contrast with kind of the overall sentiment? So a bit more information, basically, I'm asking you for.
Yeah, what's supporting the structure? Okay, first one, downside risk. I don't know. It depends on the next tweet. It depends on the next spat in the trade war. It depends on the next executive order.
Yeah.
It could go either way. If we get some kind of cooling off period for the next few weeks, then I guess there's not much downside risk. And actually, flat prices gained, a buck or two over the last week. So it's stabilizing. Okay. But if we get something else, of course, there's more risk. What's supporting spreads? I just think there's not enough evidence that the prompt market in crude or products is particularly loose. And James, you can talk about the ICE gas oil expiry in March. Very, very strong.
Yeah, indeed.
So, and then the thing I want to just point, which goes in the same direction on the horizon, I'll rattle through them, right? I can see plenty bullish things on the horizon for crude. There's the Chevron license that's getting pulled. That could be 100 or 2 KBD lost. Kazakhstan is telling OPEC it's going to rein in production because it's been massively overproducing because it was expanding field capacity. You've got things like US supply growth is flattening off. Even at Sarah Week, I think there was a quote from Harold Hamm saying that US supply growth is flattening off. And you can see that in the monthly data as well. There's talk of SPR builds from the US administration. There's always talk of Chinese SPR builds now that flat price is down. I think there's lots of good stuff, and maintenance is peaking already. So buying should pick up in the physical market. And then the bear argument, I'm just less convinced by it. If Russian sanctions get removed, okay, kind of bearish geopolitical risk-wise, but from a volumetric perspective, what does it do to the market? We can discuss it, but not much, right?
Yeah.
Then there's the macro impact of all this stuff. Let's shove that 6 months down the line.
Yeah.
I'm more convinced by the bull side, let's say, just now.
Okay, cool. All right. Well, look, James, Neil's put you on the hot spot, actually. We were talking about the ICE gas oil expiry this week and what a chart that was. But look,
Yeah, indeed.
yeah. And also, really nice to have you back, because the last time we spoke, I think it was during IEW, and you were potentially coming off your bull run on distillates. But look, diesel cracks have softened recently. So how does this compare historically? And is this just a reaction to the flat price, or is there something more structural going on here?
Yeah, historically, yeah, cracks. I mean, if we compare to the last few years and we take out kind of take out COVID numbers, cracks don't look that bad currently. But indeed, as we were talking about, during the live podcast and the breakfast briefing in London, cracks have moved, from $21 to about 17 currently, rather quite quickly, about the last 3 weeks or so. I guess kind of as we predicted, really. And then spreads in the same way. There's been some strength in the very prompts, as you mentioned just there, that, ICE gas oil expired, I think, like $18 yesterday. Yeah. And what's the cause of that? So we've seen ARBs open up probably over the last few weeks, but kind of over January, February, they were mostly closed into Europe or pointing east. So I guess it wasn't just, they didn't open quickly enough over the last few weeks in order to supply or to save March, as it were. And kind of just to give some kind of a context as well, kind of the bullish factors that we had coming into the beginning of the year also dissipated a little bit. So we had the coldest winter in like kind of US, Europe, also North Asia, probably for the last 3 or 4 years. There was a certain amount of, either strength lent from nat gas or nat gas switching. We've had the continuing, something that might end actually soon, but the weak kind of Chinese distillate exports as well. And really, I guess a big thing and a big indicator that I like to look at is that we kind of started the year before US maintenance started. We didn't really build enough stock, probably in the US and Europe as we thought we needed, essentially. So.
Yeah, we've seen some unusually kind of strong distillate bills in the US, but it'd be good to get your thoughts on that kind of heading into summer.
Yeah, well, it's kind of actually been a little bit of a change since the last EIA report. But kind of one of the few kind of bearish signals is that distillate stocks in the US had been building quite healthily, particularly in jet, actually. But really overall, if you look at historically now, and probably why I'm kind of turning a bit more bullish now, is that overall they're kind of lower than average, I would say. And I guess for me, this is kind of a bit of a decisive factor, actually, that these stocks, although they're building, kind of look historically quite low. I guess I'm kind of turning a bit bullish, really, until we kind of see the end of kind of Asian turnarounds, probably the end of April, beginning of May, something like that now.
Brilliant. I'm very glad you're back on the bullish band camp. I'm sure Neil will pitch in at some point and
couldn't stay
try
off
and
it for long.
It did feel
that down.
It felt odd that you weren't.
Yeah, look, just moving on from distillates, because I appreciate this is a bit of a round table talking about kind of, flat price and the reaction to kind of products. So look, let's get your views kind of on the light end. So Phil, you were pretty bullish EBOB last week when I listened to the podcast when Felipe chaired. So keen to hear how your positions evolved on that one.
Well, I mean, luckily it's a relatively easy call to be bullish on EBOB when it collapses the week or two prior. So it has indeed rebounded off of those lows, which was nice. But if we kind of come back to where we are in this conversation, and are we seeing anything in gasoline that is suggesting kind of recession or poor consumer demand, or any bets on any of that really coming from the gasoline side? If we take out 2020 and 2022, so obviously kind of very extreme years either way, then if we look at kind of current summer EBOB crack levels, they are bang average. They are exactly where we would expect them to be at this time of year for the last 10 years or so. In Asia, they're a little bit below. In the US, they're a little bit above historical levels, but there's still a bit of the kind of tariff angst to kind of work through there. So overall, not much direction from cracks. And then from spreads, again, we're kind of exactly where is typical for a kind of pre-pandemic March, looking forward towards April, May EBOB spreads, for example. It's very, very typical that by mid-March, you are still in contango for April, May, and that it takes until kind of the second half of April or so before you start to chew through some of those inventories that we've been talking about, how we've been moving these components essentially into storage and therefore making them a summer spec problem, making them an April and May problem. And we just need another few weeks to start chewing through those. And so essentially kind of it's new for this post-pandemic, post-Russia sanctions era to do this, but it's not new for the market overall. So there's nothing kind of particularly worrying there, I would say.
Okay, nothing dramatic. And Jorge, Naphtha, how are you feeling about that?
Yeah, I would like to start commenting like Phil. Where are we compared to the seasonal levels? We are close to the average in time spreads and cracks, both in Asia and in US. But it's a little bit tricky on the Naphtha side, because if we look at 2021, after the pandemic, that we saw a very, very strong cracks on time spreads. So if we took out that year and we compare the last 9 years, we are seeing the third highest levels for all of these indicators, time spreads and cracks in Europe and in Asia. So the market is tight. We have seen a very bullish market during this year. We saw a big collapse end of February, and then we have seen a recovery, a very strong recovery during the last week. We will talk later more in detail about the fundamentals behind it, but the main thing that we have seen is the ARB opening to Asia. Right now, an LR2 is more profitable from Med through the Cape of Good Hope into Korea or Japan than Northwest Europe, because Northwest Europe cash dips are not doing as well as the Asian ones. And also, the gasoline recovery we have seen, if you have to talk about it, it's also a big driver on the other side of the demand. Then I would like to highlight East West is in historical highs. That's also one of the reasons behind the ARB opening to Asia. And then another point would be a weaker petrochemical margins, especially in US, not linked to Naphtha because most of the crackers are run on ethane in US, but it also impacts all the petrochemical sector.
Okay. In that case, then I'm gonna catch up with you kind of and talk about more of the physical and the fundamentals around that kind of later on. But look, just as a general roundup for this, so have we convinced ourselves that certain parts of the market, like flat price, gas oil cracks, are oversold, or are we still kind of considering this bearish case still strong? Neil, do you want to? Usually, you're very good at kind of giving your opinion, especially on distillate, actually, as well.
I would say you should buy dips. Is that fair enough to say?
I completely agree.
I think so, yeah.
I think it's a bit, when it comes to ice gas oil cracks, I could see that this is a bit of a turning point currently, actually.
Okay.
I could say we've seen like ARBs open into Europe from the East Asia, or from Asia for a while. I could see April, maybe towards April expiry, staying weak. But after that, I guess I'd be looking to buy this.
Okay,
I guess. Yeah.
Good stuff. So I think the general consensus is watch out on flat price, highly kind of news reactive at the minute, and let's get into kind of a bit more on the physical side of it for now then in that case. So on crude, Neil, I'm going to come back to you for this one then. So crude spreads, as we discussed, holding up despite weaker premiums by the looks of it. So what's driving the divergence? I appreciate you've touched upon some of these points possibly before, but it would be good to get kind of a bit of a recap.
What's driving the divergence? Well, there's a couple of things that's happened, right? So it depends on where you look. If you look at Dubai, obviously, as we've touched on recently, that the kind of Dubai market collapsed a few weeks ago, but that's most of the conviction falling away from the market about sanctions, right? So the market was very concerned about the impact of sanctions on Russian and Iranian volumes. I think the market knows now that the logistical headaches that these have caused is surmountable, let's say. The one thing I'm looking at in terms of, let's say, ideas in the physical market just now is the one thing that strikes me is the North Sea.
Yep.
So partly because the Dubai market collapsed, what it meant was that lots of European light and also medium crude arbs that were arbing east for most of the year so far are now completely closed and on multiple levels. So if you look at, for example, the 40s cracking margin in Asia, that's now negative, and that becomes a problem when refiners want to hedge that margin. And the thing that is odd to me, let's say, is the prompt DFLs. So we're talking about the DFLs. They look suspiciously strong, maybe, and that's part of the reason that the North Sea looks too expensive. So one thing just to say is that I think that needs to come off, at least in the short term. And then just to point out that that would be a very short-term thing, because I think there is a lot of moving parts from the fundamentals point of view next month, let's say. So I think we've touched upon some of these things already. Kazakhstan are set to chop their supply. I think that's a fairly clear-cut thing. That might be 300 KBD of things like CPC. There will be a ramp-up in buying post-turnarounds. And the margins are still pretty good. So, they've fallen off a bit with things like gas oil cracks and gasoline cracks, but they're still reasonably strong. So a short-term correction in the North Sea, but then the thing that's probably holding up spreads themselves is going to return. The market is kind of tight, and the, let's say, marginal things on the horizon look quite bullish in terms of supply and demand for me.
So the next kind of couple of weeks then is going to be quite interesting, just in terms of supply being taken off the market, but also demand building in the market.
Yeah.
So net, we could end up kind of having the same conversation in 3 weeks' time, by the looks of it. So, okay, one to keep an eye on. James, moving on to you for diesel and jet again, if that's okay. So
yeah, of course.
The distillate arbs have been moving around quite a lot in the platform of late. So how are you looking at kind of the movements from Seeker saying US at the minute?
Yeah, I just want to be very precise about it, and because I want to make sure that I'm expressing my call properly. But I guess we've been saying that the distillate market globally has been weak for a while, probably since the middle of February until now. I think there's a bit of a turning point now. We've already seen, I think, enough heating oil, ice gas oil spreads have gone into contango over the summer months this year. That's probably, I think this is a turning point anyway. And the reasons for that, well, we've got arbs from the Middle East into Europe were open pointing west for a while, but they've now turned back to Singapore. Singapore diesel remains in backwardation down the entire curve. Actually, there's quite a lot of strength coming there, I think, because of the start of or the ramping up of turnarounds there. So the US Gulf arbs were flirting with being open into Europe over the last few weeks, but over probably the last week or so, and kind of the EIA stats that came out yesterday speak to this as well. Those arbs have closed once again adding some a bullish tinge to things. And I guess really those two things, kind of the US stuttering supply and starting Asian turnarounds, is the main reason why I'm kind of turning bull again now. I think another thing, actually, something that Neil pointed out to me before the call, is that another thing, a bullish factor as well, is that we've lost a lot of capacity, or we're going to lose a lot of capacity in Europe, probably from now until June, something like 400 KBD. That's adding already to the capacity we've lost since the beginning of the year, Lyondell in the US Gulf as well. I think there's more to come in Pad 5 as well. And that lost capacity should be, it depends how you look at it, but should be enough to kind of mitigate the ramp up of Dangote and Dos Bocas as well. So overall, the remaining capacity has to be motivated to run harder. And that's going to be margins and cracks. I guess that's another bullish thing that I see there as well. I don't know if you had something you wanted to say there, Neil.
No, I think, utilization rates are probably quite high, right? Margins have been pretty good, kind of, when we look at the indicator ones throughout the world. So I guess that incremental kind of supply through refiners, notwithstanding the ones that have been removed from maintenance, is going to be quite interesting to see. And generally, kind of, when you do see refinery closures, those refineries are usually kind of the least attractive on the margin, possibly not hitting higher utilization rates anyway. So there's a bit of a difference between nameplate capacity and actually kind of what they were actually producing off the back end or consuming from a crude perspective. But you're right, it's one of those that unless you keep a close eye on it, it can sometimes catch you out, because each and everyone adds on to something. So it'll be an interesting one to check in the balances, that's for sure.
I have one thing to add, James, just on top of that, because I've seen quite a few bearish headlines about diesel the last week or so, in terms of things like, there's going to be a lot more Middle Eastern supply post maintenance. things like the Jazan maintenance is over. But that's where it becomes important to treat each month. Don't just look at seasonality. Treat each month as a kind of sequential problem, right? And
Yeah, indeed.
that's where it's very important when usually the ARBs are pointing east out of Sika, which I think is now the case, right? When we last talked to you, then a good chunk of this additional supply presumably goes east instead of west. And then you've got specific things happening like the shutdowns that you just mentioned. Grangemouth is getting shut down. There's 2 German refineries getting shut down. So that is a slightly different problem from the bare headline, which is the winter is ending and Middle Eastern maintenance is ending, and that's it.
That signals a potential tightness in the West, right?
Maybe, yeah. Or more tight than the market might expect.
Yeah, something to keep an eye on for sure. What's the jet story?
A little bit more, just to wrap up, like on jet, it's a bit of a different story in a way. The ARBs from the Middle East are pointing west pretty clearly, even though Asian regrade is like historically strong currently. I guess I do think probably that jet cracks will follow diesel cracks, but maybe things like the jet diffs, jet spreads should start to feel like some weakness from that high US stocks of jet currently. I guess one caveat there is, kind of global or jet demand, or US and EU jet demand tends to increase as we move into summer from here. So that's something important to monitor. But overall, jet diffs and spreads, I would be bearish from now.
Brilliant.
That's me. Yeah.
I'll do a quick recap at the end in terms of the usual 1 to 2 things that you guys are going to be looking for so that we can carry on talking about it next week. So just to prep you, get your thinking hats on. So while I give kind of James and Neil some space, let's move to the light ends. So gasoline spreads are looking very normal pre-pandemic, Phil. I think you talked about, but weak post-pandemic. So does that tell us anything about the broader refinery margins or consumer demand trends that are out there at the minute?
Yeah, so I mean, I'll address that very specifically in just a second. But I suppose it just brings me to the beginning of the podcast when we were talking about, are there signals for recession or any kind of justification on the bear side? And I suppose the thing that for gasoline is the most important to keep an eye on is going to be how this impacts, consumer confidence, jobs, especially in the US, and then how that rolls into gasoline demand. I think it's obviously it's too soon to see any of that in any kind of data, but that's going to be something which I think for the summer in particular is going to be really interesting and is going to then be something that we're going to be monitoring, and it's going to filter into our TARB forecasts and everything like that in terms of how much needs to be pulled into the US. To get back to the original question though, sorry, what's the physical market telling us right now about gasoline? So it's not, it's the same story as the last few weeks or even months now. Inventories seem to be still high in ARA, and they're relatively high in PAD 1 as well. Some of the weekly stats and look a little bit more constructive in Asia, and PAD 3 is within the US at least the tightest region comparatively seasonally. So we have a little bit of a disparity there, and that has actually fed into the kind of the biggest confusion maybe over the last couple of weeks. So in terms of how prices have reacted to tariffs being on and tariffs being off, and the broader Atlantic Basin picture. So the expectation to begin with, and when we were talking about tariffs, we were talking about East Coast Canada flows into PAD 1 and how PAD 1 was going to be tight. But actually what happened, at least on the pricing basis, on the paper spreads, was that the Gulf Coast swap appreciated versus RBOB. The spread between the Gulf Coast and the RBOB narrowed rather than widened as we might have otherwise expected.
Okay.
So given that we've got the expectation, at least when we were talking about it, was that PAD 1 should be tighter. That was a little bit difficult to justify. And what we've seen kind of on the back of that is that when we look in our platform, obviously we get all of the gasoline component premia for Houston on the basis of the Gulf Coast contract, or the majority of them are versus the Gulf Coast contract. And they have almost all tanked quite significantly over the last couple of weeks. So the the components, the actual, the blend stocks in Houston have gotten a lot cheaper versus the pricing basis, which has gotten more expensive, which kind of tells us that maybe the physical market is seeing or expecting there to be a decent amount of actual component supply, but there's a kind of broader bet on US gasoline tightness, which was maybe maybe it was a bet on kind of expectations that PAD 3 intake might be lower, or yields might be lower on Mexican tariffs, for example. So very kind of prompt, premium lower, but the paper may be higher on the basis of more of a kind of strategic bet for tariffs on, for example. So looking forward now is kind of this RBOB, so the ARA to the PAD 1, the TA ARB. Those opportunities have weakened now. That ARB has weakened. It's kind of hovering around levels that are maybe open for the ARA blender to move into PAD 1.
Okay.
But that's been flashing kind of open and closed throughout the day for like the last few days. So it tells us that it should be indicative of real material flows going from ARA into PAD 1 over the next few weeks. So second half of March into April, those should be getting fixed now. So decent amounts of flows there. And typically that means that then we should see RBOB depreciating versus EBOB, because these flows are happening and that should be getting fixed now. And that will kind of turn everything around on the paper side.
Okay, that's a really interesting kind of US development then, between kind of PAD 3 components and PAD 1 balances, shall we say. So all eyes on RBOB then over the next couple of weeks for that one. Jorge, so we've seen strong Naphtha recovery, as you mentioned, especially in Asia. So what's behind the bullish momentum and how long do you think that can last?
Yeah, I think during last week we have seen two big things. First one is gasoline recovery, as things have been saying. We have seen the ARB opening to PAD 1 from Europe like 1 week ago, and this have taken the gasoline market to a more bullish momentum. This has been translated into Naphtha, especially into heavy grades. We have seen a big escalation of heavy Naphtha prices across all the different regions, US, Europe, and Asia, and also open spec has been trading higher. From the ARB side, we have 2 points. The first one is US. US has been exporting light sour. We have seen it as the best option into Rotterdam, like in our ARB calculator. During the last 15 days, we have seen it like 3 times, and the ARB is working. So that would be 1 point, more stimulus from this arbitrage. And the main thing would be, as I said before, the arbitrage to Asia. The last time we saw better economics on an LR2 from Med to Asia through the Cape, to the Cape of Good Hope, was end of last year. And after that, we saw a very big bullish momentum in the Asian market. Then the market has been more calm. We saw a correction. And right now, the price is weakening in Northwest Europe and a very strong cash diff in Asia. We have seen them building for 4 weeks or increasing for 4 weeks in a row, and is western historical highs. This has have improved Naphtha outlook. If this right now, the margin is very tight. I mean, it's a little bit better to Asia, but if this starts to trade and we see an increasing flow from the west to the east, the market is going to keep bullish. Yeah. On the other side, we have 2 things. In the short term, I think this could be like the 2 dynamics. Let's see if gasoline keeps with its uptrend and if the ARB materialize. Right now, as I said, it's very tight. But if gas diff keep increasing in Asia, the difference is going to be huge, and we are going to start seeing LR2s. So there are 2 bullish cases there. But then, as we enter in Q2, Naphtha is very linked to the macroeconomic environment, and the sanctions are not positive for that. It's very linked to gasoline consumption, and it's very linked to petrochemical demand.
Yeah.
We have seen stronger than expected petrochemical prices in Europe compared to the beginning of the year, where they were very, very low. But right now, the numbers are not that strong. We are seeing small decreases, and we see the first signs of a weak petrochemical environment coming from ethane in US. So if this impacts Europe and Asia, this will be seen in open spec Naphtha, and we will see lower levels as we enter in Q2. And right now, the gas diffs in Asia are very strong. Compared to the historical levels, there is not a lot of room to keep increasing. So my view on that is that the market can be tight in the short term, but in Q2, I think we will see lower levels for time spreads and cracks.
Fair enough. So all eyes on LR2s going to Asia, because that'll be kind of a really interesting kind of one to see if that actually materializes. but thoughts are that Asia's probably a little bit toppy, and given kind of the negative margins that we're seeing, plus how tightly kind of naphtha is correlated with the global outlook, then we're probably looking at kind of a loose Q2, shall we say, or a looser Q2. Phil, I think you.
I was just going to throw a little potential curveball Jorge's way. So by all means, bat it straight back at me if you don't want to answer it. But I was looking the other day and I saw that the pro-nap spread in the East and in Europe, but especially in the East, is now very narrow. So is that giving a little bit of, is that helping to support now essentially the naphtha market in the East? Maybe is that going to be something that we can put our bank on for a couple of months at least?
Yeah, you're completely right. I talked about pro-naps like 2 weeks ago in the market commentary. Not today, but as you said, it's a very interesting point. More than now that we are ending like the cold season, so we have to check if propane is competitive in the steam cracker. That would be a big driver also for demand. So, and as you said, in Europe, the spread pro-nap is very close to the average, but in Asia is not. So it will be worth to keep an eye on that in the coming months.
I've got two more curveballs, Jorge. One is
it's not Jorge's day today, is it?
One is that I was just thinking about how can you measure now, how good a measure are petchem margins for the global economic health? Because we've discussed for like the last year, there's going to be massive overcapacity in the sector anyway, right? Isn't that I don't follow this too much, admittedly, but isn't that the kind of wider story that's being pushed the last couple of quarters? So how are we going to tell?
There are two different trends. One is in Asia, where more petrochemical facilities are being built, and they will keep going for the next 3 years, especially in China. And then there is another trend in Europe. We are seeing more closures. There has been one announcement for 2026, but this is the only one. The trend is lower petchems in Europe and higher in the East. If you translate this to open spec naphtha and lighter qualities, it's pointing that Europe is net long. If you include, Med and Northwest Europe, it's a net long position. So they have the ability to export, and Asia is the biggest short market. So the trend is to Asia be shorter in the coming years, and Europe is going to have more naphtha to export. And regarding prices, during the last months, there haven't been like any big change. We have seen ethane in US, but not very, just linked to naphtha in that market. But if you look at ethylene and propylene, in Asia, they have been flat. So no big news from there in the last 3-4 months, I would say. But in Europe, there has been a big volatility. Since the beginning of the year until 2 weeks ago, we saw a 25% increase in prices of ethylene and propylene. And this has been one of the big drivers behind the strength in naphtha market. Right now, they are coming off, but of course, the expectation is not good in Europe. We have seen a short period of strength, but I would say we could see lower levels. We probably are going to see lower levels of petrochemical prices in the medium term.
Nicely batted, I would say.
Can I throw you my second curveball? And it's not something you need to answer, but it's just a food for thought for next time, because you'll probably have to deal with it at some stage. I saw a headline that the EU is thinking about putting together a plan to tariff US petrochemical product imports. If that would happen, how does that change the situation? But you don't need to answer it now, but maybe something for next week or something.
Yeah. I think I can answer that, but haven't seen the headline. But it would be against US tariff, so US tariff could come first, or it will be Europe just by themselves.
I think it's I don't know what it is. I think I just saw the headline.
It's a plan for a retaliatory. There we go.
But okay. Europe sort of like just to frame this, US is the net exporter of petrochemical kind of products to Europe, right? Is that a fair statement? Yeah.
That's right. Yeah. I mean, if we see this tariff, probably Europe will release more in the East, in Eastern exports. Like China sends, it's more like final petrochemicals, not middle ones like polypropylene or polyethylene. But that's another big flow from China to Europe. So probably if we see tariffs starting from between US and Asia on the petrochemical side, China would be the winner, exporting more petrochemical products, final petrochemical products to Europe.
Okay, and it wouldn't just kind of like revive the European industry overnight.
Well, not in 2 days. Not in 2 days.
Yeah, not in 2 days, of course. But...
Well, let's see. We've got a test run right now, because I think the retaliatory tariffs that have come on, I think yesterday or today or whenever or are planned now are on alcohol, right? So we've got
getting closer.
Tariffs on US alcohol, US tariffing European alcohol. So we'll see what happens to the respective markets, and we'll see if there's any proxies to learn from for that.
It is quite an interesting topic, though, about bringing resurgence back into certain countries with tariffs. It does take quite a lot of time for companies to consider, switching off kind of assets and all sorts. But during IE week, when the tariffs got announced on the US and we genuinely thought that Pad 1 was going to go tight gasoline, I had a very lengthy conversation with Miles about whether the UK was going to be part of the tariffs or not, and whether it was it was sensible to keep Grangemouth open at one point just for exporting gasoline, for sure. So it is, but look, companies take months and months and years, if not kind of, to make these really difficult decisions. So to reverse them kind of quite suddenly is hard. And Jorge, you're right, it doesn't change anything in 2 days. Okay, look, I just want to round up really quickly then. We usually do 3 from each, but given that we're quite a quorum this week, one key thing that you're looking for or you're keeping an eye on in the market over the next week, and we'll catch up next week on it. So Neil, I'm going to start with you.
Yeah, I've only got one North Sea correction. I guess the prompt TFL comes off. That's mine.
Brilliant. Cool. James?
Yeah, diesel. Yeah, east-west has been narrowing. Does it stay narrow? And so ARB's not arriving into Europe. That's my bullish case mostly. And on jet, those ARBs still pointing west or not. And also the high frequency data from the EIA about jet builds in the US. That's what we're looking at.
Brilliant. Phil?
Oh, it's very difficult this week. The TAR, the blender margin is open, which makes me want to say that the TAR comes off, but then we've got all the swing arbs into LATAM being open from the US Gulf rather than ARA. So watch Pad 3 intake and components pricing, and maybe there's a Gulf Coast versus RBOB spread there that needs to widen again. Okay,
brilliant. To be fair, you were gifted Eurobob, so some of the EBOB stuff over the last couple of weeks, so I'm glad you've got a tough week. And Jorge?
Yeah, I would say the ARB to the east. Yeah,
brilliant.
Because right now it's very tight, both options, Northwest Europe and on MR, ARB2 to the east. So I will be tracking that difference with Sparta.
Brilliant. Okay, I think that's us done for today's deep dive into the wild world of energy markets. So look, we've covered tariffs, Trump, time spreads, turnarounds, and just about everything in between. If you're feeling a bit overwhelmed, don't worry, you're absolutely not alone. But look, I've got some good news for all of our lovely listeners out there. You do not have to spend your days doom scrolling through every tariff headline trying to decipher if a tweet is going to send crude up or down $5 in an hour these days. That's because the lovely team here have just launched on the Sparta platform a real-time tariff tracker, as well as tariffs are included now in our live ARBs model for your analysis. So your one-stop shop for all the latest tariff updates, keeping you ahead of all the chaos. So think of it like a GPS for market mayhem, except instead of recalculating when you miss an exit, it recalculates when policy decisions throw the markets into the tailspins that we're in today. So if you're a trader, analyst, or just someone who enjoys a bit of financial turbulence with your morning coffee, please make sure to check it out or reach out to the team. So look, thanks for listening, and until next time.
Thank you. Bye.
Bye. Bye.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com